Alright, welcome to this explainer. Let's just dive straight in. When most of us think about real estate, we picture these isolated assets, right? A skyscraper over here, maybe a warehouse over there, but honestly, that's just the wrong way to look at it. Today, we are totally reframing the market. We're going to look at real estate as the interconnected river of capital, one that flows from raw, dusty infrastructure all the way down to those to stabilize the income-producing asset. Understanding how that river flows is absolutely crucial. It is literally the key in spotting where the real generational wealth is created. So let me just pose a quick question to you. Who really makes the most money in real estate? Just think about that for a second. I think we usually assume the path to maximum wealth is buying those finished, gleaming property right in the center of the bustling city. We see massive institutional buyers sweeping in, and we just kind of figure, oh, they're capturing all the upside. But as we follow our river of capital upstream today, you're gonna see why that assumption completely misses the point where the actual explosive growth happens. I absolutely love this quote because it brilliantly captures the reality of the market. Buying a REIT is like buying a mango from the supermarket. The biggest gains were made by the farmer and the transporter. You see, most retail investors are just hanging out at the supermarket. They buy into a real estate investment trust or a REIT at the very end of the cycle. And hey, there's nothing absolutely wrong with it. You get a delicious low-effort mango, but an explosive wealth? No way. That was captured long before the fruit ever hit the shelf. It was made by people who actually planted the seeds and paved the roads. Alright, Section 1. The genesis of value and how infrastructure pulls capital. To really understand this genesis, we need to talk about the financial vehicle making it all possible, the InvIT. So think of an InvIT kind of like a REIT, but instead of shiny office buildings, you're owning piece of toll roads, power lines, and pipelines. The big difference, the cash flow here doesn't come from the rent. It comes from tolls and utility payments. This is the financial engine that monetizes the early infrastructure that literally changes the map. Let's break down exactly how this machine operates step by step. First, the government comes in and announces a new expressway or maybe a free corridor. Next, once the cash flows from that are actually predictable, InvITs step in to monetize those assets, which gives the builders their capital back to go, well, build more stuff. And finally, because these travel times completely plummet, all those empty greenfield land surrounding the new road suddenly becomes highly developable. The roads act like a massive magnet for capital. Moving into Section 2, the Greenfield window. High risk, explosive upside. This is the crucial point to remember. Capital moves before buildings. Just imagine that tomorrow is a massive new airport or industrial corridor gets announced. At that exact moment, absolutely nothing has happened on the ground. There are zero offices, zero factories. It is literally just a line drawn on a map. And yet the smart money, they're already paying attention and they're already deploying capital. Why? Because they know exactly what follows the infrastructure. Let's actually look at the math of how this plays out because it's pretty wild. In phase 1, year 0, let's say raw land is at a baseline of 100 rupees. By phase 2, when the infrastructure actually arrives, boom, it jumps to 500. By phase 3, buildings show up and push it to 1000. And then in phase 4, when the heavy hitting institutional demand arrives, the value explodes to 2000. That is a 20x multiplier. Fortunes are made here not just because of a road was paved, but because that road fundamentally shifted the demand. But listen, here's the secret. The sweet spot isn't just throwing darts and buying blindly. The sweet spot is the super narrow window when the infrastructure is real, like the approvals are totally clear, and the road is actually being built. But the massive institutional money hasn't fully arrived yet. If you wait until everyone and their family agrees the area is valuable, the explosive upside, yeah, it's already gone. Which brings us to Section 3, the institutional shift, when global players arrive. It all really starts with the arrival of GCCs or Global Capability Centers. Years ago, a US company would just outsource their tech work to a local firm. But today, multinational giants like Microsoft, Goldman Sachs, Warner Brothers, they build their own dedicated full-scale operation right in India. India is quickly becoming the world's engineering and AI center. And these GCCs are now literally the largest driver of office leasing demand. But here's the catch. These global giants completely change the rule of the real estate game. A GCC doesn't care about a patch of cheap land. They demand institutional landlords. They want LEED certified green buildings, massive multi-acre campuses, highly reliable power backup, and they sign really long stable leases. A small local builder simply cannot easily deliver a 500,000 square foot state-of-the-art tech campus. They just can't. So these forces a massive shift in who actually develops the land. First, massive institutional developers step in to build these grade A office parks. Then the GCCs lease them, generating huge stable rent. But developers, they want their cash back so they can go build the next park. So what did they do? They sell these new stabilized buildings to REITs. The developer recycles their cash and the REIT secures super safe predictable rental flow. It's a whole ecosystem. Okay, section 4, the risk and the return reality. Let's analyze the assets. Let's really break down your options here side by side. Just look at the extremes. If you buy a raw plot of land, your yield is basically zero and liquidity is really low. It is super hard to sell fast, but the appreciation potential massive. On the exact opposite end, look at a REIT. You get a solid medium yield from a professional management and high liquidity because it trades right on the stock market. You're getting real estate benefits without having to actually deal with the buying and managing a building yourself. So the absolutely crucial takeaway, here is the stark contrast. Greenfield investors are taking on significant uncertainty and risk because they are chasing explosive multi-bagger appreciation. They are the farmers. Meanwhile, REIT investors sitting all the way at the end of the river are buying stabilized, mature assets specifically for safe, predictable cash flow. They are just happily buying the mango at the supermarket. Alright, our final section, section 5, shifting your mindset and spotting the future. To truly master all of this, you have to completely upgrade your mindset. Concept 1 is the outdated speculator. This person just buys raw land and crosses their fingers, hoping for some random appreciation. Concept 2 is the institutional advisor. This is the sophisticated approach. They're not just out there looking for land. They're meticulously analyzing master plans, zoning maps, and infrastructure pipelines to identify exactly where the institutional capital, the GCC, and the big REITs will aggressively want to be 5 to 15 years from now. They don't predict real estate. They anticipate the flow of capital. And that brings us to my final thought for the explainer. The question isn't really what type of real estate is best. Honestly, that's just the wrong framework entirely. The question you really need to ask yourself is at which stage of the value chain do you really want to play? Are you comfortable with the high risk, high reward Greenfield window? Or do you just want the liquid, stable cash flows of the REIT stage? Because wherever you decide to step into this river of capital, that is exactly what will determine your risk, your returns, and your entire time horizon. Think about where you want to play, and I'll catch you in the next explainer.